Hello, and welcome to another episode of Investment Banking Secrets. Today, we'll be answering the question: what is the difference between the money market accounts, and money market funds? Let's start with money market accounts. What is a money market account? This is quite simple. A money market account is just an interest-bearing account that's offered by a bank to a deposit holder. So this account differs from ordinary savings or checking accounts in that they incentivize the account holder to maintain a large amount in the bank. In other words, they encourage the account holder to keep a large deposit with a bank for an extended period of time. And they do this by offering relatively high interest rates, conditional on the account holder maintaining a minimum balance. So you're required to keep a minimum account balance. And if you have an amount in your bank account that's equal to that minimum account balance or higher, then you get paid a higher rate of interest than ordinary savings or checking accounts. You can usually withdraw your money at little or no notice, so you have immediate access to your funds. But the only distinction is they offer you a higher rate of interest if the minimum balance in your account is above a threshold. So money market accounts have little or nothing to do with the actual money market, and they have little or nothing to do with money market funds. Next, what is a money market fund? Okay, a money market fund is just a vehicle that pulls together the funds of individual investors in order to achieve scale. And then it invests this money in money market instruments. So individual investors may not have the adequate capital or regulatory authority to be able to invest in certain money market instruments. So for example, in South Africa, in order to invest in treasury bills, you need to be registered with the South African Reserve Bank. And in a treasury bill auction, you can only submit a bid for a minimum amount of 100,000 Rand. So an individual investor might not have access to that amount of capital. So what they do instead is they would give their money to a money market fund together with a whole bunch of other investors. And the money market fund would then be registered with the South African Reserve Bank, thereby overcoming that regulatory hurdle. And also, by pooling together all of these funds, the money market fund would achieve scale. And so a bid of 100,000 Rand would not be too big a deal for a whole pool of investors as opposed to one individual investor. And money market funds invest in money market instruments on behalf of these individual investors. Okay, so only instruments with a maturity of less than 1 year, these are typical money market instruments. And for a money market fund, you're only allowed to invest in such instruments, and the average duration of the fund itself may not exceed 90 days at any given point in time. So finally, what is the money market? What are money market instruments? So money market instruments are financial instruments, and a financial instrument is just a contract that represents an asset to one party and a liability to another party. So a money market instrument is a financial instrument that has a tenor of 1 year or shorter. Okay, so it's short-term instrument to raise capital or to achieve a certain yield. The money market itself is an over-the-counter market, so it's a whole network of dealers, and it's facilitated by banks. And the main use of the money market is it solves a timing problem for government and corporate entities. So in the case of governments tax their population and they receive money periodically throughout a financial year from tax receipts. However, what happens if the government needs a significant amount of money today to invest in a road, a bridge, a school? It needs to somehow raise a large amount of cash today in order to be able to invest in whatever it was tasked to do by the people who voted the government into power. So there's a timing problem. The government can't wait until it accumulates enough tax revenue to undertake that investment. So what the government needs to do is it needs to bridge that gap, that timing gap between the time where it does have sufficient cash and the time where it needs to make the investment. And the money market facilitates that. So governments will go into the money market and they will raise funding, and investors will supply government with those funds in return for yield. Now, the same can be said for large corporate. They also will enter the money market because they need to invest in certain projects throughout a year, but they don't have the cash on hand today in order to invest in those projects. So similarly, they will go into the money market and issue financial instruments, receive the money from investors, and in return, they will pay the investors a yield. So if we look to the right, we have a diagrammatic representation of the money market. We have providers of excess capital. Now, remember we spoke about money market funds, and these would be right, the bottom arrow there, where funds are pooled from individual investors and they bring their cash into the money market. You also get the Reserve Bank that acts on behalf of the government, okay? And the Reserve Bank typically buys treasury bills from a whole host of institutions, such as banks usually. And that's done in the form of a repo auction. And we'll speak a little bit about that later. So by buying these assets, these usually treasury bills, the Reserve Bank injects money into the money market and takes these assets onto their balance sheet. And what we've seen in modern monetary theory is the Reserve Bank also buys other assets, such as commercial paper, in the form of bailouts. So when they offer struggling corporates a lifeline, they will buy the assets of these struggling corporates. We saw it in the subprime crisis. They bought collateralized debt obligations from struggling financial entities, and they took these instruments onto their balance sheets, and they then injected money into the system. But for now, we're just talking about a 1 year tenor. So these are typically money market instruments. So they're playing in this space with the treasury bills, and they're doing that via repo auctions. And all a repo auction is the Reserve Bank says, I will buy whatever treasury bills are on your balance sheet, talking to the banks now. I'll buy them from you because you need the liquidity today. But in a week or 2 weeks' time, you will then need to buy them back from me. So it's a form of short-term lending. Okay, so the treasury bills come onto the Reserve Bank's balance sheet. You could think of that as collateral. And in return, the Reserve Bank gives money to the commercial banks. And in a week or two, that transaction is reversed, whereby the Reserve Bank then transfers the treasury bills back to the bank, and the banks then transfer the cash back to the Reserve Bank. Okay. And then lastly, you have the banks themselves, through depositors and via corporate entities that bank with the individual banks. These banks now have excess capital, and what they can do is they can then invest in the paper that's issued by other banks, which is these negotiable certificates of deposit. So it works almost similarly to a treasury bill. There are some nuances here. A treasury bill is a discount instrument, meaning you pay a low amount today and then you receive the face value at maturity. And the difference between what you pay today and what you receive at maturity represents your yield. Whereas for an NCD, or negotiable certificate of deposit, you pay an amount today and then you get an interest payment on top of the face value of what you paid today. So that's a yield instrument, not a discount instrument. So there's some subtleties, but the mechanics are the same. Banks issue NCDs, governments issue treasury bills. So banks with excess capital that are chasing a bit of a yield, or you'll see this in the overnight market where a bank has got excess liquidity. In other words, the Reserve Bank will stipulate that the bank has to hold a certain amount in reserves and the bank has got excess cash. The bank can then give that cash to another bank that is in deficit, and they do that via NCDs. So the bank would buy an NCD from another bank, which is just a form of paper. It's a promise. They pay that bank a certain amount of money in return for that the other bank's promise to pay the capital and interest back at a certain date in future. So the bank with excess capital has now given cash away to another bank that's in deficit in return for a promise from that deficit bank to pay capital and interest back, and that's an NCD, and that's how that works. So all of this is facilitated in the money market. So the borrowers of short-term capital, as we mentioned, are the bank. Let's say the bank that was in deficit, it needs to raise cash. It issues an NCD, receives cash from another bank, and therefore it meets its liquidity ratios imposed by the Reserve Bank. And they facilitate that via this NCD. It's just a short-term bond, if you want to think about it that way. The Reserve Bank will act on behalf of the government as well. So governments typically raise money using treasury bills, and after they raise that money, they have the banks that invest in these treasury bills. The banks put their money with the government, and the government then takes that money out of the system and builds roads, schools, etc., etc. And then finally, the corporates, which issue their commercial paper, which is like an NCD. It's just a promise. It's a piece of paper that says, I'll pay you your capital back plus interest. They issue these instruments in the money market, and the typical purchases of those are investment funds. They typically subscribe for commercial paper, and the corporates use that money for various corporate purposes. So the money market is a whole web that weaves together individual dealers, banks, the Reserve Bank, government, which acts through the Reserve Bank, and individual deposit holders and individual investors. And basically the money market is the place where providers of excess capital put their capital, and providers or people who need short-term capital access that capital. And the money market just brings those two together. And the instruments have a tenor of 1 year or less.